Hello, everyone. Hello. I see some people pouring in here. All right. Happy Friday to everyone up here in Charleston. Stay warm this weekend. I heard it's going to be in the single-digit wind chill. Hey, Pat, Jolene, George, Tara, Seth. Hello, everyone. Jay. Let's just give it about 1 minute for people to pour in. We're expecting a really big crowd. So, and of course, if anyone gets disconnected, if anyone gets pulled in another direction during it, we will be recording this. We will be distributing it. Or if you miss anything or you want to rewatch it, we will have this on YouTube after it goes through compliance and everything. So, all right. Hello. I can't say hello to every person who said hi, but good to see everyone in here. I'm going to get going just because, like I said, it is being recorded. So let me get out of chat. Let's go to our slides, and we are going to start the presentation. All right. So, yeah, we always like to kick the year off with one of these updates. Where we kind of shine a light on what's going on with the markets, the economy, and then usually, we share some news about what's going on in the office, something exciting that we're working on as a firm, and maybe just some updates with our personnel. So without further ado, here's our compliance slide to keep me in the good graces with all the lawyers and the compliance people out there. So read every last word of that, if you will. And this presentation is going to be a touch different because usually I save the firm updates to the end of the presentation, and I talk markets and economy in the beginning. But this one's going to be kind of flipped on its head because we've got kind of a really cool big announcement for individuals who work with us. And one of the biggest challenges that we've had as the company has grown. On the top left corner, that was a little client event we did. I think that was a State of the Union on the USS Yorktown. It's a good problem to have, but it's a problem nonetheless. There's, I think, going to be like 400 plus people who signed up for this webinar here today. Last I checked, we help 1,300 households, and that was a long time ago. I last checked that. You can see this little map here in the bottom right corner is just kind of a push pin of the different families that we help out there. Last I checked, I think we're helping people in about 30 different states. Now, naturally, it's congregated mostly there in South Carolina on the coasts, but we've got clients all across the country, and we've got a lot of clients. So we like to do our State of the Union events. We like to kind of press the flesh, Oktoberfest. We like to do these face-to-face events as much as possible. Because that's what we did when we were small, and that's an awesome way for us to connect. It's a competitive advantage of ours for us to be give back to our clients the way we do, and for us to be so available to our clients. But it's somewhat unfair to our clients throughout the country because they can't get on an airplane and come see us. And it's also becoming darn near impossible for us to secure event space to host the crowd as big as they've gotten. So we want to continue this tradition of giving back to our clients, but we're going to do it in a different way this year. Not that we're not going to continue to do get-togethers, but we're basically going to take that budget that we typically spend on buying you guys food and drink, and we're going to deploy it at things that are going to help you guys from a financial perspective. Because I'm also well aware of the fact that you don't pay us to party with us. You don't pay us to have food and drink together. You pay us to watch over your wealth and make sure your money passes to your heirs multi-generationally and all the things that we promised when you first came on board with us. So without further ado, one of the things we're really excited about is a new offering that we're going to be unrolling. And before I go into the details of that, I think it's worth all of our while to kind of share the vision of this little company. Prior to starting our firm, I had positions at a couple different places. One was at a big trading operation, so a company that traded options professionally, and I was on a trading desk, and I got to experience life on the floor of the stock exchange, and then after that, I moved on to a large hedge fund, and this hedge fund was what's called a family office. And one of the things I bore witness to there was you had to have at least $20 million to walk in the front door. You had to have $20 million of investable assets in order to retain this company's services for their family office offering. And not many people had 21 million. Most people had hundreds of millions. In fact, the company that I used to work for recently sold, and there was a press release, and they said the average client at this company had $75 million. And the company managed, I think it was $12 billion. I forget, don't quote me on that, but it was a substantial amount of money. And what made the planning and investment experience so different for the families who have $100 million and the people like my mom and my dad is when you walked into that office, you were going to get helped on every front of your financial life, right? So your taxes, the planning that goes into your taxes, the preparation of your taxes, your investment selection, a robust investment selection, not something like, hey, you can buy like the old Henry Ford quote, you can have any color you want so long as it's black. You had a agnostic fiduciary sitting in front of you, not agnostic spiritually, but agnostic financially. So they weren't beholden to a certain product or trying to make a commission. They were able to educate you about all your investment options out there. They were able to help with your legal document preparation and educate you about how probate works, how estate planning works, what type of legal documents you need in good order and structures of those legal entities, so you don't pay a red cent more in taxes than you're legally obliged to. And one of the takeaways I had working at this place was, you know, a lot of these people who have $100 million, a lot of them made their money the old-fashioned way. And the old-fashioned way for them was they inherited it. And that kind of bothered me, quite frankly, because I watched my mom put clown makeup on and get terrorized by children to make $150 on a Saturday with her business. And I watched my dad wrestle with his job security because of layoffs at his company. And I said, why is it that these people are getting this awesome investment family office experience, and people like my mom and my dad who, don't feel sorry for them because they were born here in America and they saved money and they've amassed a great amount of wealth because of that. But middle-class millionaires, the mass affluent, people who are my people, are suffering this experience where you've got kind of an estate planning attorney in one silo, you've got a financial advisor in another silo, and you've got an accountant in another silo. And the three blind mice, none of them really know each other by name, and none of them really work together in unison whatsoever. And we've run into this on many different fronts where, I'm trying to reach out to one of my clients' accountants, and I'll drop them an email or I'll give them a call and leave them a voicemail, and I don't get a return phone call. So then the client needs to kind of send up a flare and say, hey, we need, your help here. Can you please respond back to Adam? And, tremendously inefficient, tremendously client unfriendly. And our vision for our company, and we're going about doing it, is to become a family office. We want you to be able to walk into one door and have all of your investment and your financial planning needs met. Not just investments, not just income planning, not just retirement planning, not just investment selection, but also we want to be a resource for you as it relates to putting together your estate planning documents. We want to be a resource for you with your tax planning and your tax preparation. Now, the tax planning element, we've already got a pretty good grip on. We've got some tremendous software that can help you take advantage of the law the way it's written to save money on taxes and not pay a red cent more than you have to. We have not yet secured the individual to sign tax returns. I spend every waking hour of my life interviewing accountants and finding that person. So I am confident that we will, but on previous webinars, I've talked about this. I do not get into relationships with people on the business front lightly. I want to know that there's some loyalty there and it's going to be a long-term relationship. Our ideal lifetime relationship is forever. This is not something that I'm just going to build up a business and sell. My intention is to keep this business for the rest of my life and for next generations of leaders and owners. So anyways, that's the vision of this place. And the next slide is going to talk about our next kind of offering that will help bring that to fruition. So we've retained an estate planning platform that we're gonna, for commit clients now. So if you're watching this, I think we sent this out not only to our clients, but individuals who are just in our mailing lists and people who've kicked our tires in the past. But if you actually work with us, the platform that we're utilizing provides living wills, trusts, financial powers of attorneys, and healthcare directives free of charge. So starting March 1st, we're going to be hounding you to do estate planning visits. And on the next slide, we're going to talk about exactly what that looks like. And we're going to talk about, we're not trying to replace your estate planning attorney, nor are we trying to stomp on the toes of estate planning attorneys here in our market. In fact, we're legally not even able to provide legal advice, right? All of the legal advice and the compliance is behind a Chinese wall. That is wealth.com, the outfit that we're using to help put together these documents. But we want to be a resource to our clients. And so many of you, what we've come to see is have a will or a trust, but you didn't put it together. You haven't reviewed it in over 10, 20 years. Some of you just have never gone through the process of putting together a will because you haven't got around to it. And let's face it, walking into an estate planning attorney office might be kind of one rung above or below going to the dentist's office. It's not something people look forward to doing. And what we've come to see, not necessarily with our clients, but kind of our clients' parents and ancillary relationships that we encounter as our business has gotten bigger, is a client's parent might lose their marbles or their health might begin to diminish. And the client is trying to help the parent handle their finances or make decisions surrounding that parent's health. And there's no financial powers of attorney in place. There's no healthcare directives in place. And if we could be a resource in getting those things secured, we want to do that. And what you'll see on the next slide is a lot of quote unquote estate planning is not done in a lawyer's office. Our beneficiary designations, understanding how money gets dispersed from IRAs versus non-qualified accounts, and how we title our contingent beneficiaries. Beneficiary designations, TOD arrangements, supersede that of probate. And it really doesn't matter if you've got a will or a trust. If you've got an IRA and you've got living entities listed as your beneficiaries, that will or that trust doesn't really come into play. So I think it's our job to protect our clients. It's our job, even though we're not technically estate planning attorneys, and we're not trying to become estate planning attorneys. Some of you might have children with special needs or substance abuse issues. You might be in a blended family with some dysfunction there. You might have exotic assets. You might own some farmland or vacation real estate. In those cases, we're going to push you out to a competent, capable estate planning attorney. Those are the people you need to be visiting with. But if you fall into this group of individuals that just have never looked at their legal documents, have no intention at looking at their legal documents, or if you're one of these people who put together a will, you put together a trust, haven't reviewed it in 5-10 years, you've moved since then, your children are no longer minors, they're up and out of the house, your beneficiaries might have changed. We want to be a resource for you, and we want to be able to be the people you can lean into. And let's face it, I know there's some estate planning attorneys on this call right now. You're probably cringing and, coming up with the reasons that we need to be careful. Don't worry, we're in compliance. We have our own attorneys, but Heck, I forgot what I was even getting at. We're not trying to step on your toes. We recognize that you serve a wonderful purpose, but we also, I know what I was thinking. We also have bore witness to, how do I put this lightly? A little old lady with a tremendously straightforward estate. You know, a little old lady with 2.5 kids. The 2.5 kids get along just fine. Has one piece of real estate with a white picket fence. Not a lot of assets, got a little pension, IRA. And, you know, that person steps foot in an estate planning attorney's office and is getting charged thousands and thousands of dollars to put together very, very basic legal documents. So I believe it's my responsibility, if I'm going to quote unquote be a holistic financial planner, which is a word I think gets thrown around too lightly, if I'm going to be a fiduciary to my clients, I think it's my responsibility to protect them from overpaying, whether it be for their investment advice, their investment counsel, and even some of these documents that we can now put together for individuals using our partner platform at no cost at all to our clients. So that's what we're most excited about. There are, you know, we're going through this process with all of our employees right now. And then there are a couple dozen clients that are going through it with us right now. They're almost our beta testing individuals. But come March 1st, we're really going to be beating the drum and sounding the alarms that, hey, if this is something that you'd like to go through, and then even if you have a trusted relationship with an estate planning attorney, that still yet doesn't cover some of the things I'm about to talk about. So come March, when we start offering this as an additional product offering, the first step is you're going to want to schedule either an in-house or a virtual estate planning review with one of our advisors. There's going to be some homework that you need to prepare before you come and see us. Heck, my wife and I, we went about the process of putting our trust together, and the topic of who is going to care for our kids when we're gone came up. Also, the topic of what would you like to do with your remains when you die? Do you want to be cremated or do you want to be buried? And to spring that question on you in our conference room without you having any opportunity to think through that and come up with a solution, one, wouldn't it be fair for us to do that? And two, wouldn't it be very productive from a time perspective for us either to sit there and watch you guys mull over if you want to be cremated or buried, or, you know, who you want to take care of our kids. Who you want to take care of your kids if you have minor children like Claire and I do. Or heck, maybe it might be a fur baby. Who do you want to take care of your pet? So we'll have some homework for you before you come to the office that was pre-populated by our platform. And you could basically come prepared. And then at our office, we're going to do a full plan estate planning review. Now, what that means is we're going to review your beneficiaries. If you have non-qualified accounts, we want to make sure you have POD or TOD arrangements on them. That stands for transfer on death or payable on death. We're going to educate you on the difference between per stirpes and per capita arrangements on your beneficiaries. Just to kind of shine a light on that, if you have per stirpes designations and God forbid one of your children were to predecease you, oftentimes what happens is people don't update their beneficiaries. And that child who predeceased you might have kids of their own, your grandchildren. And because a per stirpes designation was not put on the beneficiary forms, those monies will not pass on to your grandkids. So say if you have 3 kids, your assets are now dispersed 50-50 to the other 2 living children. So if you put a per stirpes designation on those beneficiaries, then that individual who passed on's share gets passed on to your grandkids. We might even consider moving your grandkids up on the contingent beneficiary line. If you recall the Secure Act, which passed, I don't know, 3 or 4 years ago, and then they turned around and they revisited it not but a year ago via Secure Act 2.0, did away with what's called the multi-generational IRA. Prior to the Secure Act, we used to be able to stretch our IRAs via inherited IRAs for up to 120 years. Now, if you meet your maker, your IRA is to be distributed within 10 years. Well, if you only have 2 kids and you have a sizable amount of money in your IRA, well, you're going to be passing a sizable amount of money out of that IRA to 2 entities. if your intent is for some of your money to go to your grandkids, which most of you, that is your intent, we move the grandkid up to the contingent beneficiary line, and now you have more entities to disperse your IRA to, thereby making the 10-year rule a little less tax egregious on your loved ones. These directives supersede probate, right? I think sometimes people get a trust and they go, okay, I did my job. My civic duty is done. I got a trust. But they don't really recognize how that trust blends into their beneficiary designations. Or they'll say, I should put my trust as my beneficiary. That's not always the wisest choice. And I know sometimes estate planning attorneys think, well, you got a trust, you should put it as your beneficiary designations. What they don't recognize is custodial relationships. Custodians, things like Schwab or Fidelity or Vanguard, they might not jive well with a trust as a beneficiary in order to stretch and do different transactions that sometimes happen when someone passes on. Talking about those custodians. So some custodians are what I would call more beneficiary friendly than others. A lot of 401ks, plan documents have not been updated since the passing of the Secure Act. So if your money is in a 401k or an employer-sponsored retirement plan and the plan document has not been updated, your children might not have the opportunity to take your IRA or qualified money out over 10 years. They might be required to take a lump sum. Or it could be a situation where one of your children want to pay the money out over 10 years and one of your children want to take a lump sum, and they don't require differing beneficiary payouts across your children. This is all stuff we've known. This is all stuff we've known in-house, and it's just kind of lived in our head. It sat in the back of our mind while we did our planning with you, but now I'm seeing it kind of as our responsibility, because I'm not even sure a lot of the people who seek counsel from surrounding estate planning really specialize in this area. They don't understand the difference in custodians. They're not spending a tremendous amount of time updating beneficiary arrangements and TOD arrangements. How to fund a trust, that's one of the things that you'll hear. Not only do we design your trust, but we fund the trust, right? We can show you what that means and show you the different forms necessary to go about you having your trust funded with different types of assets. And then just some useful tips on how to title personal property. A very simple one would be your cars. A lot of people, when they buy a car, and this is not legal advice, look this up yourself. Stay in the good graces of our compliance people out there. But they'll put title of their car, Adam and Claire Curran. And if Adam kicks the bucket, that car, in order for Claire to sell that car, she needs to get my name removed from the car. And it's a trip to the DMV, it's submitting death certificates, it's a process. So if you put Adam or Claire Curran and Adam kicks the bucket, that means Claire is able to sell that car with a little less friction and a little less headaches and grief and one less trip to the DMV. So there's some useful tips like that we can shine a light on at that estate planning visit. And then finally, we'll plug you into wealth.com. Wealth.com is going to basically walk you through a questionnaire in order to set up either a living will or a trust, and also get your medical powers of attorney and your financial powers of attorney in order. And then also you could ultimately get that packaged up and sent to you at your own cost, or you could just have PDF documents that will ultimately need to be signed and then the trust needs to be funded. But it walks you through all of that, and our advisors will be a resource for you. They won't be the ones putting the legal documents together, but they will be the ones holding your hands and acting as translator as you go through the process of putting these documents together. If you already have a will or you already have a trust, there's some technology built into the platform that reviews your trust, just ensures that it is designed as you initially wanted it to be designed, and also shines a light on some different changes in legal code that you might want to take the opportunity to update the trust or make amendments to it. So we could be a resource to many people on many different fronts, but it's something I'm really excited about, and I think it's just our next step in our vision of turning Current Financial Partners into a family office operation that helps you one door, many different services. All right. Let's go over markets now, okay? Because we shined a light on our new exciting announcement. But many of you are here basically to talk about, the great 2024 crash is usually popular headlines that come across the wire at the beginning of the year. People are either fear-mongering or euphoric about AI stocks, one or the other. It's never like a muted, calm version of what they think market's going to do. It's either going to be the greatest bull market in the history of mankind, or we're all going to be eating bugs in a bunker, one or the other. But boy, you look back at 2024, and I love this quote. Someone said, one of the best years in the market that didn't feel like a very good year. Didn't it feel like that this past year? Turned out to be a pretty darn good year in the markets. S&P 500 was up 24%. The NASDAQ, which, mainly technology stocks, a lot of that Magnificent Seven names are big components of the NASDAQ, was up over 41%. Bonds, not a good place to be. The bond aggregate, as indicated by BND, only up about 1.95%. Vanguard value stocks, these are dividend-paying stocks, up about 7%. Most of that growth occurred in the last 2 months of the year. Heck, I was looking at dividend stocks, around October, and they were down or flat, whereas tech stocks were up, 20, 30% at that point in time. So not a great year for value stocks, but 7%, not bad either if you just kind of didn't panic and held on to them. And finally, the crypto 200. So Bitcoin, Ethereum, all the other, I was going to say something mean, but cryptocurrencies out there, the 200 biggest cryptocurrencies by market cap, up over 141%. You look back at some of the storylines in 2024, though, 3 of the 4 biggest bank failures in the history of American banking occurred, right? You've got interest rate hikes. We're going to shine a light on how many interest rates hike happened this past year. Looks like we got a new war in Israel and Palestine, and the war in Ukraine and Russia. It looks like they're still fighting in Washington about giving Ukraine more money. Inflation, has come down a little bit, but still yet the price of goods at the grocery store still feel awfully high. So there's just been a lot of negative news coming across the wire, yet the market performed relatively well. The narrative you're going to hear a lot about this year in 2024 is right now, the market is really fickle. You haven't noticed that by now. If you turn on CNBC and there's green on the ticker tape, you'll hear people say soft landing, soft landing, soft landing. The Federal Reserve has steered us towards a soft landing. Okay, since World War II, the Federal Reserve has achieved 1 soft landing and 19 crash landings. So they're 1 in 19. If your favorite football team was 1 in 19, you'd want to fire the coach and basically move the football team to a different city probably. But when the Federal Reserve does it, we still put merit into what they say because, of course, you don't fight the Fed. But you'll hear right this very minute, soft landing, soft landing, soft landing. If you go back and review any of the webinars that I've done, I've been worried about what's called a secular bear market. Right now, a secular bear market is a prolonged period of time where the market pops and it drops. You have severe chop, but you squint your eyes and you take a step back 10 years from now or 15 years from now and you go, boy, market's kind of been stuck in the muck. Hasn't really moved up all that much. And that's exactly what you see from the end of 2021. We're basically back to where we were at the end of 2021. So we're in a 2-year cycle right now where it's been exciting because AI stocks and crypto's up and the technology stocks were down in 2022. But when you look at the S&P 500, it's basically flat. It's been flat the entire time period. So I happen to think we're in a secular bear market. Does that mean the market goes up this year or goes down this year? Well, I'll unpack some of that. I'll also say this. Every year about this time, the economists put their genie hats on, or their soothsayer hats on, and take out their crystal balls, and they make market predictions. There was a white paper released where someone actually took those market predictions issued by some of the most renowned economists and market forecasters. And they basically said, okay, what did these people say at the beginning of the year, and what actually happened to the markets? And only about 8% of the time were those market predictions within 1 percentage point of the actual movement of the S&P 500. 8%, I would say, qualifies as dumb luck. Because really, if you just run around saying, hey, the market's going to go up 10, it's going to go up 10, it's going to go up 10, there's a good chance the market might go up 9 to 11. 1 out of, 8 times out of 100. So market predictions are not very useful. There is a long and rich history of people claiming they've got their finger on the pulse of Lower Manhattan and getting it dreadfully wrong. I mean, look at just what happened this past year. Who saw the regional bank crisis happening, right? Who saw, Israel and Palestine and, that terroristic attack happening? There's too many things that could come out of left field that even if you had access to all of global economic data, predicting the market's movements on a year-by-year basis is a losing game. I do happen to believe, though, when we look at things macroeconomically, the Federal Reserve is 1-19 in achieving soft landings. So the fact that you turn on the TV when there's green on the ticker tape and every single person, every man on TV wearing makeup says soft landing, I have a hard time believing that. I think secular bear market is a little bit more likely. I think that's exactly what's playing out right now. When you look at the end of 2021, we're back to where we were at the end of 2021 because we had a terrible 2022. And of course, 2023, we springboarded back up. So those are going to be the two narratives you hear on both sides of the screen as people argue about where they see markets going. I recognize most of the people on this call don't have more time to go back to work. They don't have the capacity to sustain major losses in their portfolio. So betting on a soft landing, there's actually more inherent risk than investing money a little bit more cautiously on the chance that we are in fact in a secular bear market. So more on 2023, if you look at where all the returns came from in 2023, and I did a whole webinar on this where we talked about the Magnificent Seven, the 7 names in the S&P 500 with market caps weighting close to 30%, drove most all of the growth of the overall stock market in 2023. I like this slide. It basically says all of the market's returns were concentrated in high risk, low quality stocks, right? High risk represented by beta. Beta is ultimately a volatility measurement. So the stocks that are the most volatile, the highest risk, were the companies that drove a lot of the growth in the S&P indices last year. And then finally, low quality. So this is gauged by what's called return on assets. So if I had $1 million of assets and I was able to create a business that generated $5 million of revenue, that would be a return of assets of $5 for every 1 million for every $1 of assets that I have. And typically companies that have high levels of return of assets, meaning they make a lot of money, on their assets, are high quality assets. But a lot of the businesses that drove the growth in the indices last year were low quality. So from my vantage point, working with retirees, if you recognize that investing is a long game, it's not a sprint, I would rather own low risk, high quality stuff over the long haul. But no doubt, you got to own some high risk stuff because those are the companies that are changing the world. Those are the companies that offer us moonshot potential. But just recognize if you're looking at your portfolio and you're going, boy, tech stocks are up 40% and my portfolio's growth is a little more muted. It's because you probably own some stuff that's of high quality and low risk, which is what you should own as a retiree. Because, of course, when the tide goes out, we see who's swimming naked, the old Warren Buffett quote. Rest in peace to Charlie Munger, too, by the way. Passed away in 2023. So I like this slide, too, a little more economic nerdy stuff. And it's basically showing the S&P trailing earnings per share growth, and then actually economic estimates. And you'll notice historically, these two lines kind of run in unison. They're very, very synonymous, right? So basically people look at economic leading indicators, and then they look at the S&P 500's anticipating earnings growth, and they jive. They run in parity to each other, or in correlation with each other. Well, look how divorced those two lines are heading into 2024. Basically, what this tells us is that economic data shows stocks going lower, but all of the estimates offered by analysts show stocks going significantly higher. One of these is going to be right. One of these is going to be right, or might be somewhere in between. Even if it's somewhere in between, that would represent a market that goes down. So big difference in what the analysts are telling us and what the economic data is telling us. So I did a webinar, I think it was in September, and it was the title of that webinar was The Anatomy of a Recession. And it was pretty nerdy. I'll warn you if you go back and watch it, it's on YouTube. But I had 15 slides on leading indicators pointing to us falling into a recession. And there's about 12 leading indicators that most economists keep their finger on. And typically, if 4 of them is trending negative, that's indicative of us falling into a recession. At that webinar in September, basically all 12 leading indicators were negative. So the fact that we haven't fallen into a recession yet, right? We very well could be in one right now. It's 2 quarters of negative GDP growth. Is shocking to most economists out there. It's shocking that all these leading indicators are pointing to, doom and misery, and house prices just keep chugging along. Here's the 2 that I fix your eye on. One is the job openings, right? Because when people have jobs, that's usually the best indicator of recession. When people are employed, can't be all that bad. At least I got a job. Every 2 weeks I get a paycheck. Well, job openings are starting to drop here. Now, they're still high comparative to what we've seen over the last 20 years, right? So both for service-oriented jobs and manufacturing jobs, we've seen a sharp drop-off in 2022 into 2023. So we'll see if that trend continues into 2024. And then this is the one that, I was starting to get encouraged by civilization. During COVID, people started saving money. Do you believe it? If people were not living like the Smiths to keep up with the Joneses during COVID, and as a society, we had a surplus savings rate, meaning people were actually saving money for about a 2-year period, mainly during COVID, probably because in many parts of the world, you weren't even allowed to spend money. You weren't allowed to go to a sporting event. You weren't allowed to go to the shopping mall or a restaurant. Well, throughout most of 2023, we just slowly went back to being a society that spends more than it makes. So our savings rates have absolutely plummeted to where now we are living like the Smiths to keep up with the Joneses. So this represents job security for Dave Ramsey and the Dave Ramsey Show. He'll continue to be talking people off debt ledges and debt cliffs for many years to come with the behavior that we're illustrating right now. So people are not saving money. They are blowing through it and leaning into lines of credit. On that very same webinar, I showed you a trend line as to where credit card rates were. I don't remember, don't quote me on this, but I think it's 30%. I know it was in the high 20s. The average credit card APR right now is darn near 30% per year. Please don't be borrowing money on credit cards that you're not paying off on a month-by-month basis. All right, and of course it's an election year. You just barf real quick in my trash bin. So these are our elections since 1928. I pulled this from a presentation actually Michael Bear did in our office at our last election cycle. And of course, the year in which Trump and Biden went toe to toe in 2020. I believe that the market was up that year, not up much, but that was, of course, that funky COVID year where the market dropped 20 or dropped 40% and then wind up finishing the year up because that's what $8 trillion of stimulus money will do. So it's kind of an unorthodox year. But when you look back at different presidential cycles, okay, so on this slide, I am shining a light. There's 100 years of presidential cycles, and you'll see Republicans and Democrats who won these different cycles. And there's been 24 presidential cycles across the last 100 years. And only 4 instances where the capital markets were down the year of an election. So only about 16% of election years does the market go down, meaning 84% of the time markets go up in an election year. Under normal years, not election years, markets are down around 27% of the time. So 27% of the time annually the market goes down. In election years, it's only 16% of the time. So take that for whatever it's worth. But I'll hear people say, oh, it's an election year, the market's going to crash. That's actually not proven when you look back at history. The market crashes less likely in an election year than it does in a normal year when there isn't an election occurring. Now, this data has been proven to be very, very accurate. And that is 3 months prior to the election. Okay, so if you want to be a day trader, here's some good day trading advice. So if the market goes down in value 3 months prior to an election, that there's an 87% chance the incumbent party loses. So if you think Joe Biden is going to get ousted, or the Democrat Party is going to get ousted, we're not even sure it's going to be Joe Biden. If you think that's going to happen, it's a strong possibility, an 87% chance historically, that markets trend downward August, September, October. So there you have it. Now, if the markets go up during that 3-month period, there's an 87% chance that the Democrats re-win the Oval Office. And again, we're talking about just the Oval Office. We're not talking about the seats available. I think what you'll see, Michael's going to be doing a webinar probably on that very thing, politics and capital markets, how many House seats are up. Been a lot of retirements lately, a lot of also people dying in the geriatric center that is the halls of Congress. So we'll do some more on this in the future, but I wanted to just shine a light on some different trends we've seen surrounding election years and capital markets. And truth be told, there's not much of a direct correlation. Every year is a little bit different, but those were 2 trends that I thought were interesting. And of course, our inverted yield curve, which is now the longest inverted yield curve we've had in 40 years. We've never had an inverted yield curve last as long as the inverted yield curve we have right now. This thing has predicted our last 10 recessions, and it's just remained inverted for months upon months upon months, and we have not yet quite seen this great recession that they're so good at predicting. So I got to shine a light on it again, though, just because it's so darn accurate at predicting recessions. And right now we've had the longest inverted yield curve in my entire life. But with that, rates are coming down. Okay, so what you're seeing here is a yield grid for CDs that we pulled directly from Schwab. And it shows us CD rates as of earlier this week. And it compares those CD rates to what I shined a light on back in September. and not major changes on the short horizon. So you can see a 3-month CD right now, you can get about 5.2%. Whereas back in September, you could have got about 5.5%. But look longer out, 5 years out, okay? So back in September, if we were to buy you a 3-year CD, we're getting over 5%. Right now, you're at 4. Even on a 2-year basis, a 2-year CD, 4.4%, 5.3. So our recommendation then, as it is now, is in a inverted yield curve environment, in an environment where all leading indicators are pointing to a recession, in a secular bear market, what you want to do with a portion of your wealth is make intermediate term predictable business decisions. So our take is if we can secure 3 to 5 year fixed instruments that are going to pay us 5 to 6%, and I specialize in working with retirees, that gives me a tremendous amount of confidence that this individual has a portion of their portfolio in things that are going to slowly and surely move the ball down the field, regardless of how bad the recession is, regardless of what these leading indicators are all telling us. Not to mention, if you look at the yield curve, typically making those longer decisions, you're not going to be rewarded as much. We can still get 5 years at 5+%. We can still get 3 years at 5%. There's still opportunities out there to lock in and kick the can down the road at reasonable interest rates, because conventional wisdom tells us to put it all in a 1 year or put it all in a money market. $6 trillion in money markets right now. So people are saying, hey, I want to put it in a money market because the money market, heck, our money market model in-house yields over 5%. And we've got a lot of money in the money market model because most people, they want liquidity. And if you give someone the choice of, do you want, 100% liquid at 5% or 3 years at 5%? 9 out of 10 people are going to go, give me the 100% liquid option. But what I'm here to tell you is as rates drop, it might be worth your while at securing a 5% rate, because 6 months from now, 1 year from now, 2 years from now, when you go to refinance that money market or you go to deploy that money market at something that is predictable, you might not get the rates you're seeing right now on the open marketplace. So if that resonates, if that makes sense, by all means, you can lean into us and we'll show you kind of what this yield grid looks like across all fixed instruments that are out there. And here's why we're seeing rates drop, okay? So this is the Fed's tightening cycle. So the quote-unquote pre-tightening cycle ended in the beginning of 2022. There was no rate hikes. Yet we saw the 10-year Treasury start to creep up, right? Now, the reason the 10-year Treasury creeped up was because the markets were looking at inflation data going, uh-oh, the Fed's got to do something. The inflation data is pointing to, a Fed that's got to intervene here. And then, of course, the rate hike started in about March of 2022. There was 15 rate hikes in the quote-unquote aggressive phase. So 15 rate hikes. We saw the 10-year Treasury move to about 2.25, 2.5, all the way up to over 4.25 at its peak, and then it dropped a little bit. And then most recently, in the late phase of the rate hike cycle, as it's called, there were 6 rate hikes where we saw the 10-year Treasury peak to just shy of 5%. And then you'll notice recently, if you look on the right side of this screen at that slide, that little movement downwards, if the stock market dropped 20% in a 1 or 2 month period, there would be calamity in the streets. People would be freaking out. Well, although I got to tell you, y'all investors have become pretty battle hardened, because that's happened like 3 times in the last few years where the market's kind of taken the stairs up and the elevator down to that degree. But if capital markets drop 20%, usually people are freaking out and kind of wondering about the sky falling. But when it happens to interest rates, no one really says peep, saw a headline yesterday that mortgage rates are the lowest they've been in 7 months, right? So we're seeing interest rates drop very, very quickly. Now, that's also a precursor to a recession. Just like interest rates went up pre-tightening, that was the market going, okay, inflation's a coming. The Federal Reserve is going to have to raise interest rates. You see this movement downwards. That's our market saying, okay, looks like we're about to fall into a pretty bad recession. Job openings are starting to kind of leave the table. Interest rates are going to be coming down. So there's two different dynamics with interest rates. There's the markets, which are made up of buyers and sellers, investors, and deployers of issuers of debt. And then there's the Federal Reserve. And the Federal Reserve ultimately dictates the federal funds rate, which has an impact on the 10-year Treasury rate. So what we're seeing is interest rates dropping after this aggressive and late phase of their tightening cycle. So a common conversation being had at our planning table is refinance. A lot of times when you see the word refinance, your knee-jerk reaction is, I don't have a mortgage, Adam. I don't need to refinance. Well, certainly when interest rates go lower, you refinance your debt. You refinance your mortgage. You consolidate your credit card onto a home equity line of credit. You consolidate your student loans into a lower yielding chassis, right? Well, what I'm talking about when I say the word refinance, this is the Fed funds rate. This is what the Federal Reserve really controls. Many of you that have fixed instruments, whether they be fixed annuities, bonds, CDs, money market rates, these things were purchased and established in a artificially manipulated zero interest rate environment. What this chart shows you is after the financial crisis, the Federal Reserve came in and artificially manipulated interest rates to zero. Then in about 2017, you started to see interest rates kind of creep up where they peaked right before COVID, right? Because if you remember, in that period of time, we had a white hot jobs market. Everything was coming up aces, and then boom, COVID hit. And then as soon as COVID hit, they went back to artificially manipulating interest rates to zero. So many of you have fixed annuities, fixed indexed annuities, CDs, bonds, fixed instruments that were established, created in a zero interest rate environment. Well, now the Fed funds rate is up over 5%. So that's a 500% increase in interest rates. So just like when interest rates go lower, we refinance our mortgage. When interest rates go higher, we refinance our secure investments, our fixed, our linked investments. And oftentimes, in order to refinance, just like with a mortgage, you have to pay new loan doc fees. You have to have your house appraised. There's a cost to moving from point A to point B. Now, you make that decision because by moving from point A to point B, you have a smaller monthly mortgage payment, or you're able to pay your house off quicker. Same thing goes with our investments. There may be a cost, a surrender penalty. Look at an I-bond. They're going to claw back 3 months of interest. CDs might also have clawback charges. But you're willing to sustain these clawbacks because ultimately the grass is greener on the other side. It might cost you $1,000 or $2,000 to get out of an instrument, but you could come to see that by putting your money into an instrument that's yielding 500% more than what you currently have, you are going to be made whole and break even in a very, very short period of time. And then you have a longer term instrument locked in at a higher rate. So when you come to our office, do not be surprised. Many of you have already had this conversation with me or one of our advisors, but do not be surprised if the word refinance comes up. When they're talking about refinancing, they're not talking about your mortgage or your debt. Most of you who work with us don't have any of that. But what we are talking about is refinancing your fixed, your linked instruments into things that are going to yield a higher percentage. God, I know I'm nauseating how much I've gone over this, but I got to shine a light on it. This is the most recent Vanguard Outlook for financial markets. They do this, I think quarterly they release this. You can search it. You just go Vanguard Outlook for financial markets. We like Vanguard. We put a lot of merit and weight into what they say. I think they're one of the good guys in the financial services industry. They introduced the index fund to the world. An index fund is one of the most efficient, inexpensive investment chassis a Main Street investor can plug into. And Lord knows Wall Street hated them at first because they kind of stopped the big fee, big commission party that was happening prior to Vanguard's existence. Now, the downside of Vanguard, in my opinion, is their mindset with how you should invest your money is just buy and hang on for dear life. And there is a lot of merit and validity to that, especially if you're 30, 40, even 50 years old. But as you get close to retirement, and when you're in retirement, any of you who are retired can relate, you have a very different relationship with your money in retirement compared to what you did with your money when you were 40 years old. If the market dropped 20, 30, 40% while you were working, well, sure, you felt it, you were stressed, there was some anxiety, but your mantra was, I'll just hang in there, the market will rebound. And that's typically what happens, albeit sometimes rebounds take, many years or even a decade to get back to where you were before. Well, that's Vanguard's kind of prototypical mantra. It's, if you're in your 60s, have more in bonds. And if you're younger, have more in stocks and just hang on for dear life. So it's really not in their best interest to have these types of growth rate projections. This is what they anticipate equities to do over the next 10 years. They only anticipate U.S. equities to grow to the tune of 4 to 6%. Growth stocks, those very same highly volatile, low-quality stocks that drove all the growth in 2023, they only anticipate growth stocks to grow to the tune of 1 to 3%. Well, at the bottom here, I'm looking at cash. Cash is going to grow 4 to 5% with no risk. So you're sitting there going, wait a second, why would I take all of the gut-wrenching risk that U.S. stock markets provide when they're telling me I'm only going to make 4 to 6% when I can lock things up and make 5 to 6% in fixed instruments with no risk whatsoever? So when we're giving out investment advice, you'll find we're having a slightly heavier hand towards what we would call the base of the pyramid, because, whereas 5 years ago or even 10 years ago, if we put money in fixed instruments, CDs, fixed annuities, cash, we're only making 1 to 2%. Now we can get 5+% with the same level of principal protection. Makes a lot more sense to us to have bottom heavy pyramids, especially with all the leading indicators that I've shined a light on this webinar and other ones. And yes, we still love dividend stocks. And here's why we like dividend stocks. This shows dividend stocks comparative to the S&P 500 after an initial rate hike, during a rate hike, and after the final rate hike. So literally, anytime the Federal Reserve gets involved with interest rates, dividend stocks have been a good place to be. And even when you look back at last year, when you look at the Vanguard Value Index, VTV, up 7%, you could go, oh, well, the S&P is up 24%, even though most of that growth was driven by low-quality, high-risk stocks. I don't want to say I'm happy with 7% because most portfolios that we manage are going to have some growth names blended into it. But 7% growth rate is not going to hurt your portfolio. Our dividend model, last I checked, yielding close to 6%, right? So of course, when you own a dividend stock, you're not really worried about the price of the stock going up and down, because that's what's called a paper gain or a paper loss. What you're more concerned about is a predictable, stable, secure dividend. So we still like dividend stocks. And here again, you come in and you plan with us. You're going to be having a conversation about refinancing, locking in good fixed rates. We're going to be having a conversation about dividend stocks, how those work, and why I believe they're really a lifeblood of any retiree's portfolio. All right. And in closing, here's just some pictures of some of the individuals on our team. Up there in the top left corner, you'll see Kat and her sisters. And, Kat works in our office, and she's also kind of our house manager. She changes my baby's diapers and watches our kiddos, but really acts as kind of an executive assistant / house manager. And Mike and his family of 4, he's got the same number of kids, but they're younger. This is him at Seacoast during their Christmas celebration. There's Susan with her kiddos. David and Jake are getting married in T-minus 3 weeks here. Catherine up there in the top right corner, I think that was at her sister's wedding. You've got Brittany with her family during their Christmas celebration. Aunt Nikki with her 2 new nieces down there in the right-hand corner. Of course, we all love Colin. Colin welcomed his baby girl into the world. Has it been over a month now? Yeah, probably. Heck, she's probably about 1 month old at this point in time. And his wife, Danny. And then, of course, my little circus / tribe of kids down there at the bottom. I just want to thank you from the bottom of our heart. This year was a tremendous year of change for us. And I want you to know you don't do business with us out of charity. But I could promise you, in doing business with us, you are supporting a business made up of high character, principled people doing life the right way. When I look at our locker room of teammates, I see people scratching and clawing to pay down debt, to afford that first house, making babies, sending kids off to college, raising kids the right way, teaching them traditional American values. And again, I know you don't do business with us out of charity, but I can just tell you, as the leader of this organization, what you're seeing right there is only about 1/3 of our company. There's so many other individuals who work here. And I can go on and on about each and every one of them, and the different changes that are going on in their life, and the different, principles that they lead their family units with. And I just want to thank you for doing life, doing business with us, allowing me to run this little organization that's having a profound impact, not only on our clients, but the people who get to work with me side by side. It's just incredible to see the growth of each one of these people, both professionally and personally. Thank you all so much. Let me see if there's some chat questions I can address right off the rip. Oh my goodness. We'll be adjusting our accounts in Schwab. Okay. I don't want to get into our Vanguard financial outlook. Over what number of years does this chart reflect? 10 years. It's a 10-year outlook. Hello from Sun City. Hey, John. Okay. Did it talk about precious metals, gold and silver? Yeah, we own gold and silver in most all of our portfolios. All the world's gold fits in an Olympic-sized swimming pool, but it would just sit there and glisten. It wouldn't pay dividends, wouldn't pay interest. So I don't think gold is going to be the pill that cures all that ails you in a market like this either. All right. What's your take on Bitcoin's ETFs? Well, hey, adds a lot of validity to the asset class. It's probably one of the reasons why the Crypto 200 was up 141%. And if you've listened to me at any length, I'm not one of these individuals who thinks cryptocurrency is make-believe money. There's some validity to its scarcity. And the whole ecosystem that's built around it is very, 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 very disruptive. So the ETFs being issued just adds validity to the entire asset class, makes it a little bit more meaningful. A lot of that growth, I think, has already kind of been missed, though. Thanks, Adam. Thank you, guys. I know I didn't address every single question. Oh, there's a Q&A only area now. Okay, will there be a replay? Had some grandkids. Yeah. Garland, you had a good reason to not see it. You had grandkids to come over. That's a better reason to watch my high-pitched Yankee voice carry on about the market. So, yes, there will be a replay. Looks like some people wanted to speak. I don't know how that works. I'm not even going to click that button. Y'all, thank you. Thank you. Anything piqued your interest, call our office up. We'll get you an advisor, and we'll talk you through it. But be on the lookout. If the estate planning thing was of interest to you, call our office up. Be one of the first people to go through that process. Any of the investment, ideas that I shared and shined a light on, please lean into us, and we'll get back in touch with you. Thank you all so much.